Okay, welcome again to our series of country profile videos. This is where we spend a bit more time looking at a particular country in detail and thinking how it can be relevant to your A-level economics. In this session, we're going to focus on Ethiopia, an agrarian economy in transition. Back in 2000, Ethiopia was the poorest country on the globe in terms of per capita GDP. According to IMF data, GDP per person was merely $124 in current prices. That's clearly changed in part because of the rapid development and growth that Ethiopia has experienced in recent times. So Ethiopia is a developmental state, and Ethiopia's ruling party is the People's Revolutionary Democratic Front, and that's been in power since 1991. And it's got a very strong grip on the country's politics. In the last election, I think they won 500 out of about 550 seats. And crucially, of course, if you have a one-party state with authoritarian tendencies, there are issues to do with democracy and human rights, internal politics, but there's also an opportunity for countries to fast forward their growth and development. Ethiopia is trying to achieve rapid industrialization, and we'll see in a few minutes a key role there is for logistics infrastructure, including rail and air. They're also trying to build a sort of a nascent tourism sector. They have an Ethiopian Airlines, one of Africa's biggest airline carriers. But as we'll see in a few minutes, they have a fairly low trade to GDP ratio, and that could well hold them back. And one of the key problems they have is a very large current account deficit, which looks to be unsustainable. We'll look at whether aid and debt relief and FDI can enhance development along the way. Ethiopia's aim is to become a middle-income country by 2025. It's got some way to go, of course, but it's growing very rapidly. Put things in context, if you think about the share of world GDP, despite several African countries growing strongly over the last decade, indeed many of the top 10 growing countries in the world are from sub-Saharan Africa, that region still accounts for only 3% of world output when we adjust for purchasing power parity. It's important to make a distinction between growth and development. Economic growth is really focused on both an increase in GDP, but fundamentally a sustained rise in the long-run productive capacity of an economy, and flowing from that, an increase in GNI per capita. Essentially, when we think about growth, we tend to think about productivity and capacity. Development, of course, is a much more holistic, a broader concept. We think about progress in expanding people's basic economic freedoms, hopefully achieve sustained progress in terms of improving people's economic and social opportunities. And two key words on the development agenda at the moment are capability and resilience. Capability linked to know-how and the human capital that can drive investment and output and jobs in higher value industries. Resilience is a really key concept in development economics. In particular, how can we make people and families and localities and regions and countries more resilient to external economic and sort of geographical shocks. Paul Collier has developed an idea of the development trap, and he argues that countries can suffer from one or more of these four development traps: conflict, over-reliance on natural resources, being landlocked with bad neighbours, and bad governance. Well, Ethiopia is landlocked. Ethiopia's National Development Plan is a key part of understanding their progress in the process towards becoming more of an industrial economy. They have a 5-year plan. The current one is the Growth and Transformation Plan. I think it's number 2. And the aim is to become, for Ethiopia, a global light manufacturing hub. We'll look at some examples in a second or two, as well as building a more climate resilient green economy. Those people who, with a knowledge of history back to the mid-80s, of course, will remember the famine in Ethiopia, which precipitated Live Aid and other fundraising initiatives. Ethiopia also wants to become a net exporter of energy to other African countries, and their ultimate goal is to become a middle-income country by 2025. This chart shows the rate of investment in Ethiopia. It's really quite important. By the way, on the left-hand side, I'm going to use a little box linking the data to particular topics on your A-level syllabus. You can see here that there's been a significant increase in investment in Ethiopia in the last 20 years, measured as a share of GDP. So it's gone up from the sort of 15% mark from the 1980 to 1999 to close now to 35, even 40% of GDP. Much of that, of course, is infrastructure investment funded by the state. But investment levels in Ethiopia are almost on a par with Chinese levels. So a sort of rapid increase in the size of the capital stock. What we see happening, of course, is that investment feeding into growth. Over the past 10 years, as this chart shows, Ethiopia has been one of the fastest growing economies in the world, with growth averaging 10.9%. Despite recently facing the worst drought in 50 years, Ethiopia has quite remarkably been able to maintain its growth. Growth did dip, obviously, in 2016 to just under 7%. The GDP's target's 11% growth target, but the IMF is forecasting that Ethiopia won't get anywhere close to that. But it'll still grow more than 7% per year. And if we factor in some population growth, then clearly rapid GDP growth does feed through to an increase in GNI per capita. So what I've done is I've plotted GDP per capita at PPP for Ethiopia and contrasted it with Rwanda, another fast-growing country, whose country, of course, was ravaged by genocide in the early 1990s. So here's two examples of two sub-Saharan African countries that are making quite significant progress when it comes to lifting per capita incomes. Now, whether that growth is fed through to an increase in human development, of course, is a key question. GDP per capita remains very low, and Ethiopia actually ranks 174th out of 187 countries on the United Nations Human Development Index. However, there has been, as you can see from this table, some progress in the last 10-15 years, particularly regarding the poverty rate. Percentage of Ethiopians living in extreme poverty below $1.90 per day is now 30% and falling. In 1995, it was over 60%. Notice in the table the significant increase in life expectancy at birth, but there is a big gap between expected years of schooling when people start school, for example at the age of 6, and the average or the mean years of schooling. In fact, Ethiopia's mean years of schooling is amongst the lowest 6 countries in the world. GNI per capita has risen from under $1,000 per year to over $1,500, still significantly below other middle-income countries. We talked about Taiwan in a previous video. Crucially, the Gini coefficient remains fairly low. It's 0.3 on the Gini index. Of course, that's in part the result of the fact that the vast majority of people in Ethiopia are very poor. Just a bit more detail on development context. Keep in mind, of course, that HDI is just one measure of development. There are other indicators you can use. Ethiopia ranks 174, and the key thing here is the low mean years of schooling. It's very low, 2.6. Somebody starting at the age of school at, let's say, 6 or 7 will have probably finished school by the age of 9 or 10. And that is clearly a human capital issue that Ethiopia has to develop. So Ethiopia is the 6th lowest mean years of schooling of all countries covered by the HDI. Let's have a think about the share of GDP by sector. It gives us a feel and a flavour for the type of economy we're looking at. So farming or agriculture accounts for over 40% of GDP, and crucially it accounts for 3/4 of all jobs and in total more than 80% of all merchandise exports. And of course this dominance of agriculture means the Ethiopian economy is susceptible to volatility on global commodity markets and also of course to extreme weather patterns. Ethiopia's agricultural sector, of course, faces many threats, not just global prices. Long-term issues include soil degradation due to overuse, resilience to drought, and relatively poor infrastructure, including basic irrigation. So this chart shows the sort of pattern of Ethiopian exports, and it's really quite important to understand how a country like Ethiopia has a very different pattern of exports from even a country like Vietnam or perhaps Bangladesh or China. Rainfed agriculture remains Ethiopia's main source of employment and exports, as you can see from this chart. And the country is also exposed to other big changes in global commodity prices, particularly for things like coffee, oilseeds and gold. Okay, so that's the pattern of exports. Here's the pattern of imports. So typically Ethiopia is a primary commodity exporter, but imports commodities, energy, component parts, finished capital goods, machinery, etc. It's a pretty standard discrepancy between the exports of Ethiopia and the imports. The key question is whether that can change in the next 5-10 years. There is some evidence that Ethiopia is becoming more diverse in terms of its exports. Can you have a look at the bottom left-hand chart here? This shows the value of the annual value of exports of what we call non-traditional goods for Ethiopia. And you can see that there's been quite a significant increase in exports of flowers. Ethiopia and Kenya have developed scale and capability in becoming exporters of flowers. They've developed a comparative advantage. So yes, there's been a bigger increase in exports of shoes and leather products, and of apparel, okay, textiles and things. But flowers have become a major export for the Ethiopian economy. Ethiopia is selling slightly more products to more destinations, so the number of product destinations is growing. Their key export market at the moment is Switzerland, followed by China, by the United States, and then Netherlands, Saudi Arabia and Germany. Now we know that trade's very important for developing countries, and this I just put this slide in case you want to press the pause button and add some revision notes to your already excellent revision notes for A-level. So it's quite important to think about why trade is significant in the long run for emerging frontier economies. It links back to the theories of comparative advantage and the debate, the evaluation over the gains from trade. So successful trade, if you can grow your flour export business, is a source of foreign currency. Selling exports is a way of funding and financing imports of key imports of technology and capital. Exports, of course, an injection into the circular flow of income with a possible multiplier effect. They should, in theory, create more jobs and perhaps more investment. And, of course, if you open up your markets to competition through trade, there may well be some gains in economic efficiency and a fall in the real price level for consumers who are already on fairly low incomes. One of the features of Ethiopia is that it has a fairly low, in fact a very low, trade openness. So this is quite important. There are good reasons why Sudan is the country in the world with the lowest trade to GDP ratio. This, by the way, just adds together the value of exports and imports each year and expresses as a share of the country's national income. Argentina, Brazil, Pakistan, again, relatively closed economies. United States, 10th on HDI, but only 28% export-import GDP ratio. Of course, the United States is a huge economy. Domestic demand and the size of domestic markets is so vast that the instinct and the imperative to export is not necessarily as strong. Ethiopia, of course, is down there, just 37.2% trade openness ratio. That's low, and it's part caused by the fact that Ethiopia is landlocked, and also, which means it costs a lot more to get goods to market, but also that Ethiopia is not yet a member of the World Trade Organization, despite having started accession talks. Some evidence that Ethiopia is trying to improve its trade relationships. Here we see an agreement recently between Ethiopia and Sudan, neighbouring Sudan, to try to create a free trade zone. And crucially, Ethiopia is part of the Chinese One Belt, One Road initiative. I've said before, but I think this strategy, this long-term trade and investment policy from China is perhaps one of the most important sort of developments in your lifetime. China trying to build new trade and investment routes over land and over sea. And crucially, Ethiopia will be part of that in terms of the access to East and Central Africa. One of the other interesting aspects of Ethiopia in recent times has been an improvement in their terms of trade. Now, terms of trade is not the same as balance of trade. It's the ratio of export prices to a country's import prices. Since 2004, despite a blip in 2013, the terms of trade have been on a pretty strong upward trajectory. The index of the terms of trade has been rising most years. In part, that represents the fact that the things that Ethiopia exports, until recently in time, certainly have gone up in price. And therefore, you're getting more per export than you might have got before. And depending on what's happened to import prices, that might well improve your living standards, because if you get more dollars per bunch of flowers sold, it means you can then spend more on the imports of essential raw materials, energy and capital. However, Ethiopia has a major weakness, and that big weakness is the size of their current account deficit. The current account deficit for Ethiopia is structurally very high, mainly because of the relatively low value of exports. Ethiopia tends to export low value products, but significant increases in the value of capital imports, technology, machinery, etc., which actually account for 45% of imports. And that's mainly, of course, for infrastructure development. Now, there are major power generation projects underway, and that should boost Ethiopian exports when completed. But the crucial point is Ethiopia has a big drain on its aggregate demand from the current account. Imports are way exceeding the value of exports, and that raises a question about whether this is actually sustainable for a relatively small country like Ethiopia. What I've done here is I've just expressed the data for Ethiopia in green, put in Kenya, neighbouring Kenya, which also runs a big current account deficit, and contrasting it here with the current account surplus that China has, although of course that surplus is significantly smaller than it was 10 years ago. Without remittance inflows, without remittance inflows, Ethiopia's current account deficit would be even bigger. This is an interesting chart showing the net flow of remittances for Ethiopia, and it's positive every year, and it's been going up, as you can see. It fell during the years of recession in 2008, 2009, but it's picked up again since. So there are over 2 million Ethiopians living outside of Ethiopia. Many, of course, escaped the conflict, the drought over the last 20, 30 years, and many have gone on to earn large sums in other countries, build a new life for themselves. So that diaspora sending money back in the form of remittances, maybe in dollars or euros or pounds, is a significant inflow into the Ethiopian economy, adding over 1% to their GNI and clearly boosting the level of savings, household savings, providing the remittances, of course, flow to individuals. The Ethiopian exchange rate is quite interesting. If you've been revising exchange rates, you'll know there's a difference between floating, managed floating, semi-fixed and fixed exchange rates. Well, Ethiopia is an interesting example of a country that follows a managed floating currency. So what they try to do is they try to manage the scale of depreciation. So the Ethiopian Central Bank uses interest rates and intervention in the markets to try to manage the currency, and their policy is gradual depreciation of the birr against the US dollar. Effectively, this is like a semi-fixed exchange rate against the dollar, but they want the birr to devalue, but only gradually. They devalued in 2011, as you can see, went up from 14 to 16 birr. Now, what's interesting, and this takes you a little bit beyond A-level if you want to skip this bit, but although the nominal exchange rate in Ethiopia has been falling, so for example, follow the grey line there, the birr against the US exchange rate inverted, so the birr is now falling. Instead of 15 birr to the dollar, you might get 23. The real exchange rate, which takes into account changes in prices in different countries, has been rising. And that's partly because there's been quite high inflation in Ethiopia, which has driven up the cost and the price of Ethiopian goods. Now, we sometimes use the Big Mac index to express the real exchange rate, but here we've got an exchange rate index. So here's a really key point for Ethiopia. Although their nominal exchange rate has been depreciating gradually, their real exchange rate has been appreciating. And that has made some Ethiopian exporters less competitive in African markets and in other markets. And it could be one reason, of course, why their balance of payments on current account has continued to worsen. There are many factors that hold back growth and development in countries. Here's one of my favourite slides showing 9 of them. I think it's probably true to say that Ethiopia probably exhibits most of these 9 sort of limitations or constraints on growth and development. One of them, of course, is being landlocked. So here's the map, which confirms that Ethiopia is a landlocked country. Djibouti is clearly a gateway country for Ethiopia. In fact, nearly all of their export trade now goes through the port in Djibouti city. And one of the ways of overcoming the landlocked trap is to build infrastructure, either to build an international airport as they have at Addis Ababa, and to build, with the help of Chinese money, a big new $4 billion 2-track railway which runs all the way from Addis Ababa to the port. This is now open. It's a significant infrastructure project, and I think it's a big part of why Ethiopia will continue to grow in the years to come. It's not just about the railway line. Yes, the Addis Ababa-Djibouti railway line is an important one, but Addis Ababa now has its own light railway system, which started in 2015, one of the very few to operate in Africa. They've built some industrial parks, environmental concerns, but the Grand Ethiopian Renaissance Dam is going to add significantly to their sort of power generation capacity. Renewable energy projects, investment in power transmission lines, and the laying of the East African fibre optic cables, trying to increase connectivity in the economy. Now, this infrastructure is really needed. Okay, according to the World Bank, 2013, only an estimated 12 to 15% of the population in Ethiopia had access to electricity, and only about 2% of the raw population actually had access to electricity. So Ethiopia has big energy demands, big country, rising national income, rising per capita incomes. Infrastructure is needed to sustain the growth. Another big part of this story for Ethiopia is aid. As you can see from this chart, the Ethiopian government benefits from quite large aid flows in sort of $3 or $4 billion a year, higher than Tanzania, significantly higher than Rwanda. In fact, aid flows were 9% of government revenues in 2014, although that share is now declining as the size of the economy gets bigger. I think aid is basically all kinds of reasons for aid, mainly humanitarian, of course, but aid is also supported by Ethiopia's geopolitical importance. It's still seen as a key Western ally in the kind of unstable, terrorism-prone Horn of Africa. Ethiopia's external debt is rising, but from a lower level than it was 20 years ago. Of course, countries like Ethiopia and Rwanda and Tanzania have benefited from the debt relief programs which kicked in about 12 years ago. And the Ethiopian government has issued some euro bonds. That's one reason why their external debt is rising. A lot of the lending to Ethiopia is concessional, so it's lent at favourable terms. Of course, that may change as Ethiopia becomes richer. I said that one of the problems that Ethiopia had was a high rate of inflation, and this chart shows it. This goes back over 40 years, essentially, or nearly 50 years now. You can see that there have been spikes in inflation in Ethiopia, often associated with drought, particularly in 1991 and 1985. But inflation in Ethiopia has been higher in recent times. Of course, in part, this is the result of the fast-growing economy putting extra pressure on resources, and it's been in part the result of increases in world commodity prices. And a big question here is whether high inflation does impede growth. What kind of level of inflation is optimal for Ethiopia? It's probably not 2 or 3%. They probably need a rate of inflation of maybe 4, 5, 6%. Sufficient for revenues and profits to be rising for businesses, not too high that poor families get priced out of markets. Another feature of Ethiopia is the urbanization rate. And again, there's thinking about the context in which countries are likely to grow. This chart shows the countries in the world with the lowest degree of urbanization in 2015. And as you can see, Ethiopia is still overwhelmingly rural, with just 20% of their population urbanized. Obviously, this will change pretty rapidly as their economy develops. The crucial point, of course, is that urbanisation has a strong positive correlation with the rate of GDP growth, because typically productivity in cities is oftentimes more than double that in the countryside. For example, Africa's urban GDP per person was $8,000 in 2015, but only $3,000 in rural areas. So if Ethiopia develops smart urbanisation, they will clearly grow quickly. So how best can Ethiopia sustain their long-term development? Well, for Ethiopia to develop, it needs to continue to grow. You can have growth without development. It's quite hard to have sustained development without growth. I think the key thing really is for Ethiopia to continue to grow, but also to turn that growth into more inclusive growth for, in particular, the more than 40% of the population. I've put here 5 key things I think are important for Ethiopia's long-term growth and development. One is to develop the renewable energy sector. There's huge, vast opportunities in Africa to do that, and in particular, of course, that then reduces their dependency on imported oil and gas and other forms of energy. There's huge potential still in countries, particularly in the east of Africa, to invest in commercial farming, to lift farm productivity, to lift value added and to lift exports, as we've seen with the Ethiopian flour sector. Another aspect is getting more domestic businesses to scale. One of the features of the African economy is that there are relatively few African businesses that are truly world-class and scaled to meet the world economy. I think there's only 700 African countries that have an annual turnover of more than $500 million. So somewhere along the line, we need more scaled businesses. Ethiopian Airlines is a good example of a scaled business in an African context. Ethiopia needs more of those. As we saw from our look at human development, it is vital, if Ethiopia wants to grow, to continue to build human capital, both at primary level and then getting more people to enter and stay in secondary and tertiary education. And crucially, I think this is quite important, often slightly counterintuitive for A-level students, Ethiopia needs to tax more. At the moment, Ethiopia only takes about 12% of its GDP in tax, and that really is not sufficient to provide public goods, merit goods, and welfare. One area where Ethiopia is growing is in labour-intensive manufacturing. A really good example to use of comparative advantage. Unit labour costs for the manufacturing of polo shirts, for example, in Ethiopia are estimated to be just 14 cents per unit. You can make 6 polo shirts or 7 polo shirts for $1. And that is less than half the level in China and in Vietnam. So Ethiopia has a significant potential comparative advantage in labour-intensive light manufacturing. That brings some gains. It gets people into the formal labour market, particularly younger semi-skilled workers. More people in work, earning a regular income, helps to cut extreme poverty. And crucially, formal employment, of course, is easier to tax. So that will expand the tax base. However, if Ethiopia is too dependent on light manufacturing, then they will soon know that capital, manufacturing capital in particular, is footloose. It can move from country to country pretty quickly. Also, although light manufacturing adds income and boosts GDP, it's relatively low complexity, low value added. And oftentimes, that production doesn't necessarily add a huge amount to a country's GDP. What you need is more complexity and more know-how in related industries. And in the long term, of course, light manufacturing, assembly of things, is open to the threats from artificial intelligence, machine learning, robotics, etc. I said that Ethiopia has huge potential in the farming sector. This is a chart from a wonderful research document from Deutsche Bank a couple of years back, which looks at the African continent and looks at the uncultivated arable land that's available. And it's huge, absolutely 202 million hectares in sub-Saharan Africa alone. And crucially, countries like Ethiopia, Kenya, Uganda, Tanzania, and Rwanda possibly are well placed to develop commercial farming, commercial agriculture, hopefully sustainable, requires investment in irrigation, etc., to grow both domestic production and for this to become a more sustained, value-added export proposition. I've got a feeling that this is going to be one of the big stories in the next 5-10 years. Copper producers in Zambia, oil producers in Angola may not necessarily do quite as well as food producers in East Africa. We'll see. There are, of course, lots of risks on the horizon. So Ethiopia is a country which is growing, but will go through cycles. The economic cycle hasn't been abolished. There are lots of external demand shocks which could hit the Ethiopian economy, ranging from a fall in oil prices or a recession in Europe or a sustained slowdown in China. Ethiopia remains highly dependent at the moment on hydro energy. And of course, that uses up a lot of water and can contribute to drought. There's a risk also that as Ethiopia grows, and particularly if the politics gets worse, that aid donor support may tail away. So Ethiopia will have to do with less aid. And across the Atlantic, there's a risk of a more protectionist US, where in theory Ethiopia could sell lots of light manufactured goods to the United States, but of course that's a risk that tariffs will be applied more heavily in the future. Crucially, of course, Ethiopia is vulnerable to climate change and droughts, and since always will be, so they need to invest heavily in mitigation of that and adaptation to make the economy more resilient. Fundamentally, resilience comes from having a stable political backdrop, and Ethiopia is perhaps its main weakness is, to some people, its strength. We have a one-party state that's dominant, but equally a lot of political unrest. There's a little agreement on what a fragile state is, but it's generally agreed that fragile states have weak state legitimacy, weak state capacity, and weak resilience to shocks. Well, Ethiopia is amongst the most fragile countries in the world, according to the Fragility in the World Index. It's not the most fragile. Central African Republic and Niger would be right up there, but it's pretty vulnerable to unrest and, of course, the threat of terrorism. So much happening in Ethiopia. It's a fast-growing country. It's emerged from very, very low income, the poorest country on the planet in 2000, to a country that's grown amongst the fastest in the world in the last 10-15 years. The growth rate's likely to slow, but as I hope I've explained in this presentation, there are lots of aspects of the A-level course you can apply to a very interesting economy in transition. Hopefully you found this useful and taken some good notes. We'll have lots of more country profiles in the run-up to the exams and things, so check out our YouTube channel for more details. Take care and hopefully see you soon.